Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at UiPath.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's do it. So the big story with UiPath right now feels like a fundamental shift is happening.
That's exactly right. The core narrative is that they're pivoting their whole operational profile.
Away from that growth at all costs mindset we saw for years.
Exactly. For so long, it was all about capturing market share. Now we're seeing a really decisive move toward profitability and, what's really critical, strong cash generation.
Which is really the hallmark of a maturing SaaS company, right?
Yeah.
The market starts to value you differently.
It does. It's not just about potential anymore. It's about, present financial strength.
So where's the best proof point for that? Where do we see that this pivot is actually happening?
You just have to look at the operating cash flow.
Yeah.
The OCF. It's maybe the most important metric because it cuts through all the noise, the non-cash expenses, and just tells you how much money the business is making day to day.
It's a much cleaner number than net income, especially in software with things like stock-based compensation muddying the waters.
Exactly. And the latest numbers show this huge inflection point. Their OCS has turned decidedly positive.
How positive are we talking?
For the 9 months ending October 31st, 2024, they generated a net cash inflow of $174.5 million from operations.
Wow. Okay, 174 million. That's not a small number. That's real scale.
And it's up a healthy 14% from the year before.
So what does that signal, really?
It signals that their business is now large enough and efficient enough to self-fund its own growth. They don't need to keep raising external capital, which makes them so much more resilient.
That's a huge milestone. But, cash flow doesn't just appear out of nowhere. It has to be driven by something.
Right. It all starts with the revenue engine.
So let's talk about that. What's driving this?
Well, the strength is overwhelmingly coming from their core subscription model. It's the heart of the whole SaaS engine, and we're seeing that recurring revenue really start to accelerate.
Okay, now, before we get into the growth rate, I have to ask about a figure I saw that. Well, it made me do a double take.
I think I know what you're talking about.
Something about $63.9 billion in subscription revenue for 9 months. That can't be right.
No, you're right to flag that. It's almost certainly a transcription error somewhere along the line. Given their scale, it's far more likely to be in the hundreds of millions, so maybe 639 million.
That makes a lot more sense. Okay, so let's set aside the absolute number and focus on the growth rate, because that's the real story.
That's the real insight here. And that growth rate is spectacular. We're talking a 52% year-over-year increase in that recurring revenue line.
52%. Now, that kind of growth, combined with the positive cash flow we just talked about, that's the definition of momentum.
It really is. It confirms that product market fit. Companies aren't just trying the software. They're embedding it deep into their operations.
And that usually leads to the next big topic, margins. High growth can sometimes kill profitability.
But that's the thing. They're showing they can do both. The gross margin expanded to 82% in that same 9-month period. That's up from 79% the year before.
82% gross margin. That is a staggering number. That puts them firmly in the premium SaaS category.
It's hugely significant because it defines their unit economics. For every dollar of subscription revenue they bring in, 82 cents are left over after the direct costs of delivering that service.
So unlike a legacy software company that might struggle to hit 60%, UiPath, being cloud-based, has almost no physical delivery cost.
Exactly. They're selling highly sophisticated digital IP. That 82% margin is comparable to the absolute top tier of cloud companies.
And that kind of efficiency must be showing up elsewhere too, not just on the revenue line.
It is. They're showing real discipline on the cost side. If you look at general and administrative expenses.
The overhead, right. Back office, legal.
Yep. That declined from 19% of revenue down to 18%.
Which might sound small, just 1%, but when you're growing revenue at 52%, just keeping that ratio flat is an achievement. Reducing it is huge.
It proves the whole organization is maturing, not just the sales team. And this focus on efficiency, it has to be feeding the confidence we're seeing from management.
Okay, let's go there next, because how a company uses its cash is one of the clearest signals you can get. What does their balance sheet look like?
It's excellent. One little clue is the $37.3 million in interest income they generated.
You only make that kind of money if you're sitting on a massive pile of cash.
A massive pile of cash. They're not starved for capital at all. Which brings us to the really high conviction signal, share repurchases.
Management buying their own stock, basically telling the market they think it's undervalued.
And they've been incredibly aggressive about it. In October 2024 alone, they bought back 1.23 million shares.
At what price?
At an average price of $12.43 per share.
Interesting. So that gives us a pretty clear idea of where management sees the value floor. But let's be skeptical for a second.
Sure.
A lot of companies buy back stock just to offset the dilution from all the stock options they give employees. How do we know this is a real confidence signal?
That's the essential question to ask.
Yeah.
But the pattern here suggests it's more than that. We're seeing systematic accumulation. They were buying in August at $11.65.
Okay.
Then they kept buying in September at $12.15 and again in October at $12.43.
So they were buying as the price was going up.
Precisely. If it was just about dilution, they might buy on dips. Buying on the way up suggests a consistent belief that the stock is still cheap, even as it rises.
And do they have more firepower to keep doing this?
A lot more. As of the end of October, they still had $516.7 million authorized for future buybacks. That's a huge signal to the market.
So for anyone listening, that $12.43 price point, it acts like a kind of psychological support level. It's where the ultimate insiders are putting their money.
It's a powerful backstop. Now let's shift from the internal signals to the external environment.
Yeah.
What's the moat protecting this business?
It needs to be a deep one. The automation space is getting very crowded.
The moat is really built on two things. First is their proprietary IP, and the second is platform lock-in.
So the IP is the secret sauce that makes the tech work.
Yeah, it's the specialized code that handles all the messy integrations with legacy enterprise systems. Think of it as the plumbing that connects SAP, Oracle, and some 20-year-old internal system.
And the lock-in. I'm guessing once a big company automates a core process with UiPath, it's incredibly difficult to switch.
It's incredibly painful and expensive. The switching costs are huge because you're not just swapping out software, you're re-engineering a core business workflow. The company becomes dependent on the platform.
Which brings us back to that 82% gross margin. That profit allows them to pour money back into R&D to stay ahead.
Exactly. They can basically out-innovate smaller competitors. It's a strategic necessity.
Okay, that's the bull case. Let's talk about the risks. What's the biggest threat here?
Risk number one is definitely the intense competition, specifically from the huge, well-capitalized cloud players. We're talking about solutions like Microsoft's Power Automate.
That's a different kind of threat. If Microsoft decides to just bundle a good enough automation tool for free with Office 365,
it immediately puts pressure on UiPath's pricing. It's the existential threat for any specialized software company. You have to prove you're so much better that it's worth paying for separately.
that's a huge challenge. What about the macro environment? Could a recession hurt them?
That's risk number two, for sure. A macro slowdown. CIOs tend to cut back on big new IT projects, and automation could be seen as one of those.
But isn't there a counter-argument to that?
There is, and it's a crucial one. While new projects might slow down, automation is fundamentally a cost reduction tool.
Right. In a recession, companies are desperate to cut costs.
So UiPath can actually become a defensive play. Companies look to them to streamline operations and save money on labor. And because they're now cash flow positive, they're resilient enough to weather that storm.
So they benefit from digital transformation budgets in good times and from cost-cutting mandates in bad times. That's a pretty strong
It's a
position.
very resilient model.
Looking ahead then, what should investors be watching for? What are the near-term catalysts?
The big one is coming up in late January 2025. That's the Q4 earnings release.
What do we need to see there?
Two things, really. We need to see that 52% subscription growth continue, and we need to see that 82% gross margin holding strong or expanding. A beat on those two will solidify this whole maturity story.
And with earnings always comes guidance for the future.
Exactly. The full year guidance for fiscal year 2026 will also come out then. And given how aggressively they've been buying back stock, you'd expect that guidance to be pretty optimistic.
And all of this is happening against the backdrop of the bigger trends in AI and automation?
Absolutely. That's the secular tailwind. They're a leader in a category that is still just getting started, really.
Okay, so let's tie this all together. What's the final thesis here?
The core thesis is that UiPath has successfully pulled off a major pivot. It's moved from just being a growth story to being a profitable, cash-generative SaaS platform.
And the proof is in the numbers. The positive cash flow, the 52% subscription growth, the 82% margins.
Right. And you couple that operational shift with the clear insider conviction from those aggressive buybacks. It really positions the company for a potential re-rating by the market.
The market is starting to see them not as a speculative growth play, but as a sustainable, profitable leader.
That's the shift.
That's a fascinating analysis. If you want more in-depth looks like this on other stocks you follow, please hit subscribe and join us for our next stock analysis.